Hi there, I'm Jennifer Lee, Senior Economist at BMO Capital Markets. So I'm going to start off with a blinding glimpse of the obvious, and that is the fact that we have gone through an extreme period of volatility in global financial markets. We are barely through January of 2016, and already we saw the Canadian dollar fall to as low as 67 cents at one point, and we also saw oil fall to below $27 per barrel at one point as well. Now, although things have stabilized a little bit, there is still a lot of concern in financial markets. These are the three things basically that were driving, that was driving all this volatility. First of all, China, concerns about China's growth, and the currency of the yuan, and what direction the People's Bank of China wants to take it in. There's concern about emerging markets in general, and of course there is concern about the Federal Reserve's plan for rate hikes. Now, in this environment of slower growth, of low for longer commodity prices, and of course the relentless drop in oil prices, we at Bank of Montreal were forced to slash our forecast for Canadian economic growth to 1.0% in 2016 from 1.7% originally. And as oil prices stabilize and pick up a little bit in 2017, we look for growth to rebound to about 2% next year. However, again, given the decline in oil prices and of course all the investment cutbacks that we're seeing across the country, especially in the oil patch, we would not be surprised to see the Bank of Canada cut rates again in the first half of this year, probably maybe as early as the spring. Now this, however, is not taking into account what Ottawa could come to the table with. Whenever the government decides to table their new budget, probably in the next couple of months, if they introduce a huge dose of fiscal stimulus or infrastructure spending, it could be enough, if it's big enough, it could be enough to take the pressure off of the Bank of Canada on the rate cut front. But no matter what happens, I think the bank is going to be on a very accommodative stance, or taking a very accommodative stance for the next year and probably well into 2017. And Bank of Canada is not alone on this front. The ECB earlier in January said that they were probably going to revisit and revise whatever their monetary stance was at the next meeting in March. In other words, more easing is coming. The Bank of Japan, officials there certainly cannot be happy with the strength of the yuan. And the Bank of England is sounding more and more dovish lately. Bank of England Governor Carney also said that now is not the time to raise rates. So that leaves the Federal Reserve. The Fed, led by Chairwoman Janet Yellen, decided to stay on the sidelines in January at their January meeting, and that was no surprise to anyone. But they sounded a little bit more dovish, very cautious, I think, on the global financial market front. Still very optimistic on the labor market, on household spending, on business fixed investment, but again, very cautious on how all the financial market volatility could hit their domestic data. So they're going to keep an eye on it for that. We still look for the Fed to raise rates in March, but that's another month and a half away, and lots going to happen between now and then. But no matter whatever the Fed decides to do, the rate hike cycle will be slow and gradual. Thank you.